Good morning, Paul Georgie from Allendale. It's June 1st, Wednesday morning, and the looks like the overall attitude this morning is a risk-off type approach by traders, as commodity markets in general are lower here this morning. We've got the crude oil down about 35 to 50 cents. Gold is steady. Stocks are down. The dollar is lower as well, down about 20 cents here this morning. Some of the major focuses here today that be talked about is open interest. We've got a large open interest in the July contracts of corn, beans, wheat, and that open interest should start to be reduced as we get closer to go out through the month of June. But we've got the Goldman roll and the Deutsche Bank roll that of the funds, their indexes that'll be rolled here starting later on this week and early next week, and that is expected to see some selling, some pressure in the nearby contracts as we go into that time frame. It's also a matter of money flow. Are we going to see money flow coming into these markets early this month? We didn't see it last month, and actually May was the worst month for commodities in over a year, and that attitude could carry through here this morning. However, on the fundamental front, we had some positive numbers as we look at it. USDA said yesterday that there's only 86% of the corn planted, which leaves about 13 million acres of corn that needs to be planted yet here in the Midwest, and 2.7 million acres of that is in Ohio, and about 2.9 million acres in Indiana. Now, the positive thing to producers is that the weather forecast is drier for the next 5 to 7 days through most of that region, the eastern corn belt, which is going to give them a chance to get some corn in the ground, and that should be helpful to the crop. But we're planting a crop that is much later than the 1st of May time period when producers would like to get it in the ground. So even though the conditions of the crop yesterday, USDA put 63% on good to excellent corn. That's versus an average of 67% and 71% a year ago. In the soybeans, 51% of the beans planted versus 71%. We also had some news out from Oil World over the nighttime that says that Germany's rapeseed crop is going to be down about 20% because of the drought, putting that total production at 4.65 million metric tons. The wheat market, the French are saying that it is the driest there in over 50 years and the hottest temperatures they've had since 1900. So positive news coming out of the talk around the trade anyway. Planting delays continue in North Dakota, Montana, the Canada prairie is still way behind, and talking to producers up there late yesterday, it appears that their only option will be to prevent planting on the spring wheat in those areas. Winter wheat crop did improve by 1% in the good to excellent category on the USDA report yesterday. In the livestock, choice beef was up 31 cents, select up 78. However, overnight we're seeing cattle futures under pressure, down anywhere from 50 to 70 cents. Cattle slaughter is running above a year ago levels, and Rich Nelson noted in our research meeting yesterday afternoon that one reason why we're seeing such pressure in the cattle trade is because of the dressed weights are coming in anywhere from 12 to 15 pounds heavier than a year ago, and you combine that with a larger number of cattle at 6% greater than a year ago, all of a sudden we have got into some burdensome supplies that we've got to work through here over the next several months. And with the heavier weight cattle and the larger numbers, and we're seeing on a weekly basis that slaughter levels aren't reaching the numbers that we need to. So we're backing up some cattle. Looks like that could be a problem for a time here in the cattle trade and in the beef trade. And you combine that with competitive meats such as poultry, which supplies are above normal, and the hog numbers are also greater than anticipated. So we've got a problem in the meat industry that we got to work through. Pork cutout was down 18 cents yesterday. This morning, lean hog futures are down anywhere from 15 to 20 cents, and expect a real struggle here to see prices work higher. As Rich Nelson says, we need to give this hog market a couple more weeks to grind out a low, and then we'd look for a sharp rally into the late summer and winter time frame as supplies tighten up again. So if you got any questions, don't hesitate to give us a call here at Allendale. We expect some very high volatility times here over the next several days as we got money flow from the funds. We got the Goldman roll in commodities out of the nearbys into the deferred contracts, and we've got a USDA supply demand report coming up Wednesday, June 9th, that is going to have a major impact on prices as trades watching the numbers there as far as what the USDA is going to use for ending stocks on corn and soybeans. So stick to Allendale's research. We'll help you through this. You can reach us at 800-262-7538. We'll talk to you tomorrow morning. Thank you.